Hey everyone, I know some of you might be upset for missing out on Nvidia stock. The price as of this recording is over $1,150 per share, up from less than $400 per share in mid-2023 and up from around $200 per share in 2022. So those of you feeling like you missed out on Nvidia stock, feeling like it's too late to buy Nvidia stock, I've got one artificial intelligence stock you could buy instead that I think has great potential. Even though I will say, I still think Nvidia stock is a buy even at current valuations, but that's a subject for another video. I've got many videos on Nvidia if you're still interested in getting into Nvidia. But let me share with you the one stock I think is an excellent AI stock you can buy instead of Nvidia.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Alright, the stock I'm recommending here that you can buy instead of Nvidia is Meta Platforms. Meta Platforms is increasing revenue at a phenomenal rate while boosting profitability. The company has several billion daily active users, investing in future technology. Cash flow from operations is soaring. And there's many things to like about Meta Platforms. Let me share some of those with you here. Firstly, revenue in its latest quarter jumped by 27% to $36.4 billion. That led to a surge in operations income, or income from operations, to $13.8 billion, up by 91%. Its operating profit margin now sits at 38%. The business model is incredibly lucrative. So Meta Platforms is investing in AI with its Llama 3, and that's another step towards building the world's leading artificial intelligence. I mentioned earlier the company has 3.24 billion daily active users on the platform, and that was an increase of 7% year over year. Despite the fact that it has several billion people already on the platform, it's still finding growth, and that's remarkable, how it's finding people that don't yet have one of Meta Platforms' apps. That's impressive. Secondly, the number of ad impressions delivered across its family of apps increased by 20% year over year. That means there's more people on the platform, and the people that are on the platform are engaging with the platform more often or spending more time on the platform. That's great news. The average price per advertisement also increased by 6% year over year. Now, this is a testament to the strategies Meta Platforms implemented since Apple changed its privacy policy. Right after Apple changed its privacy policy, that hit Meta Platforms hard. Management said that Apple's privacy policy changes hurt the company by as much as $10 billion in revenue. But Meta has found ways to work around those changes, and it's now leading to increasing revenue, increasing price per advertisement. Increasing price for advertisement is evidence that Meta Platforms is delivering targeted ads, is delivering advertisements that marketers are willing to pay more. If these advertisements were not effective, marketers would not be willing to pay for these ads. Marketers, entrepreneurs, businesses are only willing to advertise if they feel like they're getting a good return on investment. Otherwise, they would not spend the money if they're not seeing a good return. And so that's great news for Meta Platforms longer term if they continue delivering excellent return on investment for these advertisements. Another thing I've liked about Meta Platforms is they implemented significant cost cutting in 2022 and early 2023, and now they have 10% fewer people, 69,300. That was a decrease of 10% year over year, and it's a further decrease if you go all the way back to 2022. So the company is being more conscious about the number of people it employs, which really brings down expenses because the people that Meta Platforms employ are high wage earners, and so 10% fewer wage earners drives down costs for Meta Platforms more so than perhaps most companies because of the talent that Meta Platforms employs. So management said that in the second quarter they expect revenue about 37.5 or 38 billion at the midpoint, which would be an improvement from the first quarter. But one of the things that spooked investors a little bit about Meta Platforms was the increase in expenditures. The company said for the full year in 2024, they expect total expenditures in the range of 96 to 99 billion. That was up from a range of 94 to 99 billion. This is mainly due to higher infrastructure and legal costs. Meta is building out its AI platforms, its AI infrastructure. They also anticipate capital expenditures will be in the range of 35 to 40 billion. That was up from the previous guidance of 30 to 37 billion. And while they're not providing guidance beyond 2024, they're forecasting that their expenditures will increase from current levels. So the higher spending spooked investors a little bit. And I think that's not really I don't want to say the right outcome, because I don't like to say that investors are not thinking correctly. But I think they're underrating the effectiveness of Meta Platforms' capital allocation. Over these last years, over the last decade, since Mark Zuckerberg has been at the helm of Meta Platforms, the company has been an effective capital allocator. They've used money successfully. They haven't wasted money. They haven't been going out making wasteful acquisitions, right? Their acquisition of Instagram has been incredibly lucrative. Their spending has been effective. They've made effective transitions, whether it be from when people went from using desktop to access Meta Platforms to using mobile to access Meta Platforms. They were effective in adjusting. And then they made another effective adjustment when people went from using mostly images to short form video. They made that effective adjustment to counter that rising popularity in short form video, going from images to reels. And then whether it's making investments in longer term, that's where investors are not giving Meta enough credit for those successful investments that they've made, and not saying, okay, you know what? You've proven over these last 15 years that you can manage this business effectively. So if you're spending more money, we should reasonably expect that these expenditures are going to lead to a good return on investment, a sufficient return on investment. That's my thinking when I look at companies over a longer term. If you've earned that respect, if you've earned that trust, I tend to give you more rope. And companies like Meta Platforms, like Netflix, like Amazon, that have earned that respect because the money that they've spent has been effective. And so I tend to give them more rope. I tend to give management more rope because they've earned it. They've delivered quality returns on investment for more than 5, 10, 15 years. So they've earned that bit of trust. And that's my thinking with Meta Platforms and the increasing capital expenditures. I'm happy to see it. When I see management teams that have been effective in the past in capital expenditure, I want to see them spend more because it's likely going to return a greater return on investment. And finally, you're getting this company at a forward price to earnings of 20.84, which I think is a cheap valuation for a company with this level of growth, this type of effective management, this type of cash flow, and the prospects ahead. I like this company at current valuation. So if you're feeling like you missed out on Nvidia, I think Meta Platforms is an excellent business to own at current valuations. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.